Hey, welcome to mid-October. Before I dive into the charts and show you what's happening with mortgage-backed securities this week, which is unfortunately starting out as a tough week, I want to talk to you about last week's inflation reports and what happened there. So, mid last week, we had the producer price inflation report come out. That's a wholesale number. It shows of course, the wholesale inflation and where that sits for producers, not consumers. And that showed that we had overall producer inflation increase by 0.5% overall, which was hotter than estimates of 0.3% year over year. So that inflation rose from 2% to 2.2%. Part of that was a revision from the previous month where they increased the inflation number. They had apparently for August had a lower number than they should have. And so that's been revised into the September number. So we had, unfortunately, a slight uptick in producer prices. Now, the markets tend to not react too much to that, and they didn't react to that too much. It was kind of a non-event when that when that report was released. But the next day, with the consumer price index, that was an event. Unfortunately, we saw overall inflation increase by 0.4%, which is 1/10 hotter than 0.3%. However, the year over year number remained at 3.7%, which again is far away from the Federal Reserve target of 2%, right? They want to see it as close to 2% as possible. And we're still sitting at 3.7%. So there's a ways to go. Since then, of course, some federal officials have been on camera as being more dovish and saying, hey, let's keep the rates kind of where they are longer, not move them as much as we had expected, maybe not even raise them again. So we have half of the Fed's 12 voting members, 6 of them have been on camera over the past week or two, saying that they anticipate keeping rates where they are at this higher level for longer, but not raise them again. The other half we haven't heard from as yet, but we're starting to get some out there from the more hawkish members of the Fed that are still calling for another rate increase either in November or December at their meetings here towards the end of the year. So we'll see what happens. It's a tug of war. It looks like there's an inflection point in the Federal Reserve, and the voting members are not all on board with the same direction right now, which could indicate maybe a softening stance going into spring. But for now, the Federal Reserve's higher rates for a longer period time frame that Jerome Powell has been, expressing since September 20th seems to be the mantra that is the guiding principle here with interest rates, and which has caused the bond market to kind of fall apart a bit since September 20th. Now, what I've showing you here on the screen is what's called the shelter costs portion of the consumer price index that we had last week. Shelter makes up 43.7% of the CPI. So it's a very large portion of this overall number. So what are we seeing here with shelter? Well, today we had the CoreLogic come out with their blended rent year over year change, which is supposed to be more of a current measure of renewals and new rents and what's happening. The CPI shelter cost indicated that 43.7% of the CPI is actually a lagging indicator. It goes back year over year, is not current. And as you know, it takes a while for people to change the amount they have to spend, right? Or the amount landlords are charging for renewals and new rents. So this is a lagging effect here. That's why I'm showing you this chart. The orange line shows the shelter year over year change in the CPI. As you can see, it's starting to turn the corner, right? Since this summer, it started to turn the corner, and it's 7.2% on the CPI is the shelter, component of that. But if you take current rents, according to CoreLogic, current renewals and current new leases, that is only showing a 2.9% inflation currently, right? Month to month. So this is like last month. So the Federal Reserve, of course, tends to look in the rearview mirror, tends to look at the overall picture going back 12 months. And unfortunately, there's a huge difference, right, between where it was a year ago and where it currently is now with rents, which makes up almost half of the CPI number. So if you were to do the math here and take this information, extract it out mathematically, your core CPI is 4.1% in September. If you have a lag effect of 1.9%, your real CPI, core CPI number would be 2.2. And again, the core is the portion of the consumer price index inflation number that takes out food and energy because the Federal Reserve believes that those are too volatile to include in their number. So they really are focused on the core CPI number. So if you were to use these current rents rather than the lag effect of rents, The real core CPI would right now be 2.2%, very, very close. In fact, right on target with where the Fed wants to be. So the concern here is that the Fed may, if they continue to raise rates or even keep them higher longer, they may be overshooting and causing more damage to the economy than is necessary because they're looking in the rearview mirror. So that's what I wanted to show you here today. Hopefully, obviously, we have some good monetary policy from the Fed going forward where they don't keep it too high too long or raise it even more. So let's take a look here what happened with these numbers and how that affected things in the market. The 10-year Treasury, of course, is a leading indicator of the 30-year mortgage bond, and that has had a bad week here. So as you can see, the yield is going up, right? The yield is almost up to that maximum ceiling that we've hit over the past 15 years of 4.875, 4.8. And we're almost there. We kind of came up to it and came off a little bit, but we've seen quite the destruction here in the 10-year Treasury, quite the increase in yield since July. As you can see, this has been an upward march, and especially since September 20th, an even steeper and faster upward march where it's hung in there and caused some damage to interest rates across the board in a lot of categories. Now, going to the universal mortgage-backed security chart, this is your Fannie Mae Freddie Mac 30-year fixed bond, and this is the price. So the price, this chart is the opposite, the inverse of the 10-year Treasury. It shows the price, not the yield or rate. So when the price drops, that means the yield and rate are rising. As we've seen, as you can see here, we're testing those lows that we tested back last week on October 6th again. And it's been an ugly week. Yesterday and today, we've seen a lot of destruction here with the price falling apart. So, yeah, interest rates continue to march up. In many cases, pushing 8% at a minimum, in the mid sevens. In some cases, of course, with buy downs, you can still get rates in the sixes, depending on the loan program, like FHA, for example. With buy downs, you can do that. You can get it in the sixes, the high sixes. And because sellers are nervous right now about getting inventory sold and getting the home sold, there may still be an opportunity with many sellers to have them pay for closing costs and buy down points. So keep that in mind as you're considering buying a house, or your clients are considering buying a house. There's there's maybe a tale of two different markets here in the Boise area. Anyway, we have some sellers, some homes who are just sitting there, and in some cases inexplicably, apparently the area or the price, or both are too high, or not quite matched right. And in other cases, we have homes where there's multiple offers. So it's an interesting scenario, but everybody's a little nervous. Buyers are a little nervous about where home prices are going to go over the winter, probably rightly so. And sellers are nervous about getting their home sold. So it is an interesting market. I will be putting together for next week a cost of waiting analysis that will show you with conservative numbers if prices drop over the next 6 months or so, and interest rates stay the same, and then they drop over the next 2 or 3 months. Is it better to buy now or wait, right, a year or 2 or 3? And it'll be really interesting. I think you'll find this very fascinating to see the math behind this with some conservative rates of appreciation, again, depreciation for the next 6 months potentially, and then appreciation slowly after that, and then showing interest rates dropping the next 2 months, 2 years, 3 years. Is it still better to buy now or to wait? Be interesting. Let's see how the numbers play out. We'll go through that together as an exercise. In the meantime, have a wonderful week. Feel free to reach out if you have any questions.